Welcome back. My name is Yaram John, and today we'll talk about the structures and requirements of Singapore family offices based on 13O, 13U, and 13OA comparison. Singapore's Income Tax Act includes sections 13O, 13U, and the new 13OA as fund tax incentive schemes. In essence, these schemes exempt qualifying fund vehicles from Singapore tax on specified income from their designated investments. Section 13O covers onshore Singapore resident funds, typically Singapore incorporated fund companies managed by Singapore licensed fund managers. Section 13U extends the incentive to larger non-resident or offshore funds managed in Singapore, trust companies, and feeder funds, and etc. The newly introduced Section 13OA, effective from January 2025, further extends 13O benefits to Singapore-registered limited partnerships. This aims at small private equity or venture funds. Let's first talk about the eligibility and fund structure. For Section 13O first. So only Singapore incorporated fund companies qualify for Section 13O, and they must be managed by a Singapore licensed or exempt fund management company. In practice, this means an onshore incorporated fund vehicle with a Singapore manager. Section 13U is open to any fund vehicle, domestic or offshore, provided it is managed by a Singapore fund management company. This includes Singapore companies, trusts, foundations, and master feeder structured funds. Section 13U is typically used by larger institutional funds or multifamily offices due to its higher threshold. The newly Section 13OA applies only to Singapore-registered limited partnerships with the Singapore general partner. The 13OA scheme effectively treats the LP as a fund, so partners enjoy tax exemptions on their share of the LP's income, and all 13O conditions, AUM, IPs, LBS, and etc., apply at the LP level. This was introduced to give smaller PE VC funds and families the flexibility of a partnership structure. So each scheme requires a Singapore-based fund manager, licensed or exempt, to oversee the investments. And we have to note that single-family office funds exist under 13O, 13U with even stricter requirements, but those special rules, such as higher AUM, stricter IPs, are largely unchanged and can be treated as an overlay to the above regimes. Now let's move on to AUM requirements. AUM means assets under management. So for 13O, under the 2025 rules, a 13O fund must have at least 5 million Singapore dollars in designated investments by year 3 of the incentive and maintain it thereafter. Previously, there was no minimum. For 13U, now requires a minimum AUM of 50 million Singapore dollars in designated investment maintained every year. This is a major increase from prior rules where the 50 million test was only an application. The high AUM means 13U is really aimed at large family offices or institutional funds. 13OA follows the same threshold as 13O, which means 5 million Singapore dollars in designated investments. The idea is to help small funds like VC or small PE that typically structure as LPs. These AUM tests are enforced annually after initial grace periods, so funds must truly stay at scale. For closed-end funds, which means fixed lifespans, MAS now allows an election. So 13O, 13A, and 13U funds can meet the AUM for the first 5 years and then get waived thereafter. This acknowledges that closed-end fund sizes shrink later on. Now let's move on to local business spending and investment professional requirements. But first, let's look at local business spending requirements first. All 3 schemes require the fund through its Singapore manager to spend a minimum amount locally each year on Singapore staff, office, and services. Under the 2025 rules, this is tiered by fund size. generally 200K Singapore dollars per year for small funds, up to 500K Singapore dollars for the very largest. In practice, this replaces the old flat 200K Singapore dollars rule. For example, a fund with AUM under 250 million still needs about 200K of Singapore spending. Funds in the billions must spend up to 500K Singapore dollars. Section 1308 funds follow the same LBS bands as the other schemes. And the point of the LBS is to ensure the fund contributes to the local economy, not just register on paper in Singapore. But here, you must note that funds can include fund manager salaries, office rent, and local advisory fees in LBS. And meeting LBS is a key part of the substance stance for all schemes. Now let's move on to investment professional requirements. Under the updated rules, every qualifying fund must have at least 2 investment professionals employed by its Singapore fund manager. Previously, 13O funds had no IP requirement and 13U funds typically needed 3, but MAS has aligned them. An investment professional means a qualified fund manager or analyst, often with a CFA or similar. At least one IP must be a Singapore tax resident, and for family offices, they must not both be family members. Having 2 IPs on staff is now mandatory from day one for new funds from 2025. This is to show real talent is based in Singapore. Single-family office funds technically face higher IP requirements, but those remain special cases. Any family office using a third-party Singapore manager just follows the 2 IP rule like any other fund. To look at the structural flexibility in vehicle types, 13O is limited to Singapore incorporated corporate vehicles. You cannot use 13O, you cannot use a trust, fund of funds, or LP directly under 13O. The fund is taxed at the company level, though all its investment income is exempt if qualified. So 13O is straightforward, but inflexible in structure. And 13U is for any fund, the most flexible, actually. It covers Singapore funds and offshore funds. So a foreign fund, as long as it's managed in Singapore, can qualify. It even allows master feeder or SPV structures. And MAS lets a complex fund family apply as one and aggregate the AUM LBS requirements. In effect, 13U can wrap a global portfolio, trust, companies, or any vehicle. The fund level exemption still applies, so the fund entity gets the tax break. 13OA only applies to a Singapore registered limited partnership. Importantly, 13OA is a pass-through, so partners are taxed on their share of LP income, but the LP itself must meet the conditions. MAS has clarified its no look-through, which means the LP itself is treated as a fund for compliance. A Singapore LP gives more flexibility, for example, capital calls, different classes of partners than a straight company. DLA Piper actually notes that 13OA, quote unquote, allows smaller or nascent players to use a Singapore LP, which provides more flexibility than a Singapore company. So in summary, 13U is the most flexible vehicle-wise. 13O is a plain Singapore company, and 13OA is a new limited partnership option. Each has pros and cons. Companies are simpler in some ways, and LPs are often preferred for private equity deals, and offshore trusts might be easier to use under 13U if investors are not Singapore residents. Then how can we use this strategically? So for Section 13O is best for family offices or funds that want an onshore Singapore structure. Its lower 5 million AUM Singapore dollars threshold makes it accessible. For example, a Korean HNWI with 10 million to 20 million to invest might set up to a 13O fund to manage Asian equities. So the fund would owe no Singapore tax on gains or dividends. The trade-off is the onshore requirement. The family must maintain offices, PMs in Singapore, and meet LBS, and the fund must remain a Singapore company. Also, 13.0 historically had non-qualifying investor rules, caps on who can invest, though MAS has waived many of these, for example, trust investing in 13D funds. But in practice, 13.0 is often compared to a traditional Singapore company fund with tax pass-through. Section 13U is suited for larger international families or multifamily offices. The high 50 million Singapore dollar AUM barrier means it's aimed at sizable funds. But in return, 13U imposes no restrictions on investor residency or fund domicile. A multi-generational family might use a 13U structure to pool a few hundred million of assets, perhaps via a Cayman or Singapore fund administered locally. 13U supports complex fund chains, master feeder or SPVs, so it can mirror a US-style fund structure. But the downside is quite obvious. It's expensive to maintain 50 million Singapore dollars with 2 or more IPs and $500,000 local spend. If the family doesn't actually need that scale, 13U may be overkill. And Section 13.0A feels a niche. Imagine a family or boutique PE firm that prefers the LP format. 13.0A allows them to set up a Singapore LP with only 5 million AUM like 13.0, but structured as a partnership. This is especially attractive for VC PE strategies where the LP form is common. 13.0A still demands the same economics, IPs and LPS, but the governance is different. It's a welcome stretch by MAS to capture smaller VC PE pools. But a Korean family raising capital from foreign relatives might find this useful too, because they can sign an LP agreement common internationally and still get the tax benefits. The trade-off versus 13.0 is that 13.0A requires a Singapore general partner who must meet the rules, and it may have additional regulatory complexity as a limited partner too. And to compare with other regimes, unlike the US, which has no blanket fund tax exemption for families, Singapore's schemes are relatively generous. One might loosely compare 13U to treating a Singapore fund like a US 501c3 in spirit. The fund just pays zero tax on its investment income. Both 13.0 and 13U also grant exemptions from withholding tax and GST on fund transactions, which is unique. Families often overlook that Singapore approach that emphasizes substance. And these rules, AUM, IP, local spend, are explicitly about anchoring real economic activity in Singapore. So as you can see in the presentation, 2025 reforms includes various regulations. And to give you the key highlights, there can be a new 13.0A, higher AUM and IP, tiered LBS, and removed restrictions and closed-end fund options, and also streamlined process. And all of these updates were partly motivated by OECD tax fairness standards. MAS explicitly notes that tightened substance requirements while still making Singapore attractive by easing some red tapes, like strategy changes in new 13.0A. So to sum up, Korean HMWIs or any mobile family should also consider local differences. Singapore's tax incentives mean the fund pays no Singapore tax on gains, but Korean residents must still watch Korea's tax treatment of overseas investments. The Singapore-Korea tax treaties generally exempts capital gains on portfolio sales, which complements the 13.0 and 13U exemption. Moreover, MAS's focus on substance means the family office must genuinely operate in Singapore, such as hiring staff and paying rent and etc., which is similar to OECD expectations everywhere. In my view, the 2025 changes make all three schemes more substance-driven, but also more flexible. In choosing among 13O, 13U, and 13OA, families must balance size, structure, and cost. 13O is now more credible as a real fund with AUM and IP requirements, and easier for existing funds to join and no longer must be newly incorporated. 13U remains powerful for big funds and is now slightly easier thanks to the removal of the pre-approved strategy rule. 13OA is a fresh wild card. It should be attractive for small private funds and families comfortable with an LP. For Korean family office, I would consider 13O if our fund size is modest and we want a straightforward setup, or 13OA if we prefer partnership governance. If we were going very big and could meet 50 million Singapore dollars, 13U offers the broadest reach. And in any case, it's clear that Singapore's tax schemes reward those who establish real operation there, a point all families must weigh against the benefits. In our next class, we will talk about how to choose the right entities. Until then, stay tuned and thank you for listening.